All right, Chapter 3, Accounting Cycle, Capturing Economic Events. And when they talk about the accounting cycle, essentially what they're talking about is going from analyzing transactions during a period of time, let's say 1 year, going from analyzing those transactions to recording them in the proper accounts, and then at some point, either monthly, quarterly, half year, definitely yearly, preparing our financial statements of those economic events for that period of time. And so these accounting records that we establish allow for accountability of the assets that we have. We know what we have in our asset accounts. It also establishes accountability for all the transactions during that period. We keep track of routine business activities through these accounting records. We obtain detailed information about a particular transaction because you need that in order to know if, let's say, for example, you owe somebody money, you want to know that who you owe and how much. Or if somebody owes you money, you definitely want to know who it is who owes you, how much they owe you. It evaluates, these accounting records help to evaluate efficiency and performance within the company. It's how we keep score. And it maintains evidence of a company's business activities for reporting purposes, especially to outside entities. Now, one of the things we'll look at, one of the things that is used in these accounting records, very important, is the ledger. The ledger holds all of your accounts, assets, liabilities, and owner's equity accounts. These accounts are individual records, and they show increases and decreases in those accounts. The entire group of accounts is kept together in this accounting record called the ledger. Now, we keep track of these accounts, especially when we're starting out. Looking at what we call T account. This T account symbolizes what a particular account in the ledger would look like. An account is going to have increases and decreases over time. For instance, cash. You're going to have cash come in, you're going to have cash go out. And so this T account symbolizes, for instance, in that example, the cash ledger account, or the cash account in the ledger, and increases are going to be shown on one side of the T account and decreases on another. And recall our accounting equation when you're analyzing increases and decreases. because some increases are on the left side of the account and some decreases are on the right side. Increases are on one side of the T account and decreases are on the other side. Do not believe, and so they distinguish these sides as the debit side, which simply means the left side, and credit side, meaning the right side. Do not assume that if you have a debit, it's an increase, because it depends on the type of account. Same for a credit. Just because something's a credit doesn't mean it's a decrease. It depends on the account. You have to look at primarily your accounting equation. What is on the left side of the accounting equation? Well, it's assets, right? And so for assets, an increase to an asset account requires you to debit that account. So you put it on the left side of your T account, which represents the ledger. If you want to decrease the asset account, you credit it or put it on the right side. So that's how we do it for assets. For liabilities, that's on the right side of our T account. And so for liability, you credit that account, goes on the right side. If you want to decrease a liability account, you debit that account. So that goes on the left side. For owner's equity accounts, there's capital stock, there's dividends, expenses, and of course, overall that makes this thing called owner's equity. We'll look at those separately because there's some go on the left and some go on the right. So we'll look at that in a minute. But remember, for assets and liabilities, just look at which side of the accounting equation it's on. So here they have an example of cash. Receipts increase cash account, so we debit those and we credit reductions in cash. So those are the things on the right. And then at the end of the month, what they have is the difference between their debits and credits. In this case, it's that figure at the bottom. You have a debit balance at the end of the month of $16,600, which represents the differences between cash inflows on the left and cash outflows on the right. Almost always, unless you're overdrafted, you're going to have a debit balance in your cash account. As a matter of fact, for most of these assets, you're going to have a debit balance. Right? For most liabilities, you're going to have a credit balance. You might have ins and outs, but at the end of the day, end of month, end of quarter, end of year, you're going to have a debit balance for assets, you're going to have credit balance for liabilities. Now, so we talked about this. Overall, the total overall equity account is going to have a credit balance. And to increase an equity account, you credit it. Remember, it's on the right side of the accounting equation. and then to decrease equity, you debit it. But we'll look at the particular accounts because, again, some to increase the particular account that, and there's 4 of them, like I said, to increase some of those you credit, but some of them you debit to increase. So we'll look at that here in a few minutes. We already looked at this, didn't really put a name to it, but remember that your accounting equation, if a particular transaction affects the accounting equation, you have to record it in your accounting records. And if you recall from last chapter, the balances of your left-hand side and the right-hand side had to always be in balance, had to equal each other, right? And so that gets us into this idea of the double entry accounting system, which basically means that every transaction is recorded by equal dollar amounts to debits and credits. Now, does it mean only 2 accounts might be affected? No, might be more than 2 accounts affected by a particular entry into the accounting system. But regardless, debits and credits have to equal each other. And so, again, when you have an economic event, you have to, if you're in the accounting area, you've got to analyze that economic event to see if it has an effect on the accounting equation. So, then you've got to record it. So, hopefully this will help you with your analysis skills. And then as we go along, you'll see how we go through this process of analyzing, generalizing, posting, trial balance, and eventually we'll get to preparing financial statements from this information, and then doing what we call post-closing. So anyway, transaction 1, on January 20, Michael McBrien and his family invested $80,000 in overnight auto service and received 8,000 shares at $10 per share. This is just like the one last time, except here we're using these T accounts to represent certain accounts in our ledger. And so we have cash account. We increase cash by 80,000, so we debit cash. And the other account affected, that's part of your analysis, is to determine which accounts are affected, if any. And in this case, it's the capital stock account. And so we credit to increase capital stock. Remember, it's on the right-hand side. Doesn't always mean that you credit it to increase it, but in this case you do, because that increases the overall owner's equity. Overnight purchased land for $52,000. If you recall, that was, these are transactions that occurred in the last chapter, so you should be familiar with them. So we decrease cash by crediting it, and we create another ledger account called land, which is an asset. So we debit, increase land. We purchase a garage for $36,000 by paying $6,000 in cash and issuing a note payable for the remaining $30,000. We create a ledger account called building and we debit that account. We credit cash, so we reduce cash by another $6,000, and we create another liability account called notes payable and credit that, so that increases that account. Then we pay $13,800 for tools and equipment. So we create another ledger account, tools and equipment, debit it, and credit accounts payable. Notice all these, there's double entry accounting, meaning our debits are always equaling our credits. And here we create another ledger account for a liability called accounts payable. January 24, overnight sold part of the tools to Ace Towing for $1,800, price equal to overnight's cost. Ace agrees to pay overnight on account in the future. So we reduce by crediting tools and equipment for $1,800, and we create another asset account called accounts receivable and debit it for $1,800. Now at some point, wasn't sure when they were going to get to this, but really what happens is you analyze these transactions. Okay. So it goes in this order, and kind of makes me a little mad that the book doesn't at this point really explain that, but you do, it goes in this order. If on the equation, you're going to first journalize that transaction, and most transactions, day-to-day transactions, are journalized in the general journal. It's only after you journalize that you post to the various accounts affected in your ledger accounts. Now, understand that most of this, not all of it, for nearly every company that is of any sophistication, this is done by computerized financial accounting software. Okay? And concepts are still the same, though, in that you're going to record your transaction, if it affects the accounting function, in the general journal. And from there, I threw off the... Got a little bit of a glare there. Hold on. Didn't realize there was a glare. That should be better. Okay. From there, the computer software automatically records what's been recorded in the general journal to the various ledger accounts. So in this instance, you record cash, the first transaction, cash, 80,000 debit, capital stock, 80,000 credit, and then you note what the transaction was about. That's a very important part of this, is explaining what each transaction is about with an explanation. And that is part of your what we call journal entry. And then the software simply turns around and places the 80,000 for cash in the cash ledger account and the 80,000 capital stock in the capital stock ledger account. So why do we do this? Well, the general journal, like I said, accounts for most everyday transactions, and it's simply the one place to go to record all transactions that are routine. And if and when somebody comes in, like an independent auditor, they can go to this one place to find most transactions. Now, there are some specialized journals that we'll talk about in other chapters, but just know that I realize this seems tedious and that software doesn't work like this. It's instantaneous. So after you analyze, and if a transaction does affect the accounting equation, first thing you're going to do is journalize the transaction, usually in the general journal. And then from there, you're going to post it in the particular ledger account that a transaction affects. So posting simply means updating the ledger accounts for the effects of the transactions recorded in the journal. So notice your general journal and your ledger accounts match up. And again, with software, it's automatic. Now here they're just going through and reviewing some of the transactions that have already occurred. So at the end of the second transaction, your cash has been reduced to $28,000. And so, you know, on January 21st of 2015, someone could come into the general ledger cash account and find out what the balance is. And so it's referred to as a running balance. And again, T accounts are simply a version of the ledger account that only show the debit and credit columns. The T account doesn't show a running balance. Now here, it says net income is not an asset. It's an increase in owner's equity from profits of the business. Well, for most companies, the basic formula to figure out net income is revenues minus expenses equals net income. And so this is when we get into this owner's equity account, and some things are debit balances, some things are credit balances, some things increase, some things decrease. If you have net income, meaning you have more revenues than expenses, you have net income. And that net income always increases owner's equity. But just realize that expenses reduce owner's equity. And so to increase an expense, remember the overall owner's equity account is almost invariably going to be a credit balance. So anything that's a credit increases owner's equity. So expenses reduce owner's equity. So expense accounts have a debit balance which decreases owner's equity. Revenue accounts have credit balances because they increase owner's equity. The balance in the retained earnings account, unless you're sustaining all kinds of losses, is only a credit balance because it increases owner's equity. Capital stock, as we saw with the $80,000 investment, increased owner's equity, and that was a credit balance. And remember that retained earnings after that first year represents total net income of the corporation over the entire lifetime of the business, less all amounts that have been distributed to the shareholders as dividends. Dividends, like expenses, reduce owner's equity. And so to record a dividend, you're going to record a debit. So a debit is an increase in a dividend account because it reduces owner's equity. I'm not sure why they put this here. It seems kind of out of place. But at the end of a period of time, you're going to prepare as one of your financial statements, and it's the first financial statement that you prepare, the income statement. And so the income statement summarizes the profitability of a business for a specified period of time. In this case, for the year ended December 31, 2015. Well, they started, what, January 20th? So they are on what we call a calendar year-end reporting. They report their results. They started the business in the first year on January 20. So, I mean, they can't really go from January 1 since they weren't in existence. So in that first year, it's a little bit of a shortened year. Now, in year 2, the clock starts all over as far as revenues and expenses. And we'll talk about having to close these accounts out at the end of the year. That's an important part of the accounting processes for these temporary type accounts. You've got to zero them out at the end of the year because you start recording revenues and expenses all from the beginning. You start at zero starting January 1, 2016 in this example. And so that gets to the point that we have this time period principle to provide users of financial statements with timely information. Net income is measured for a relatively short accounting period of equal length. Usually 1 year, but you can also do, certainly internally, you would probably want to do monthly financial statements. Probably don't want to give those out unless it's like to a bank you owe money to, but sometimes companies, especially public companies, issue quarterly statements, financial statements, but definitely yearly statements are par for the course. Now, what is a revenue? Well, it's the price for goods sold and services or services rendered by a company during a particular accounting period. Again, revenues increase owners' equity. Expenses are the cost of goods and or services used in the process of earning this revenue. And of course, as you've seen, expenses decrease owners' equity. We have this other principle called the matching principle. This is when we account, we don't account using, like you do with your checkbook, the cash method. We use what is called the accrual method of accounting. The accrual method of accounting is generally accepted accounting principles. Okay? And as such, one of the principles involved here in the accrual method of accounting is we have to match our revenues and expenses. Related revenues to related expenses. And we have to do that in the period in which we either earn them, if it's a revenue, or them if it's an expense. And so the matching principle says that revenue should be recognized at the time goods are sold and or services are rendered. Well, how does that differ? I mean, that's the accrual of accounting. And the matching principle says, well, we have to match it up at the time we earn it, not when we receive the cash, which will be at a later time, right? That latter example would be how we would do it in the cash method, cash method of accounting. But here we use the accrual method. We recognize revenue in the period we earn it, which is when goods are goods are sold or services are rendered. The matching principle for expenses says that these expenses should be recorded in the period in which they are used up or, as I said, incurred. Again, not necessarily when paid. There's a lot of times when you might prepay for something, but utilize a benefit over an period of time, such as prepay. You might incur a liability, but not pay it until a month or two later. You have to, because you've incurred that liability, you've got to record in the period that it's incurred, not when you pay it. And so the point here is that sometimes you receive cash or you pay it in a prior period, but you don't report it till a later period, that would be when you have a customer who's, in the case of cash received, if a customer prepays but you haven't provided them a service or sold them a good, you can't, and you receive it in 2015 in this example, you don't provide the good or service until 2016, you just put it on your books as a prepayment, and you can't recognize the sale and the revenue from the sale until 2016 when you provide the good or service. Same goes here as far as if you've provided a good or service but you've sold on credit and you're going to be paid, let's say you provide the good or service in 2015 but you're not getting paid till 2016, you've got to recognize the income from that sale in 2015, not when you receive the cash in 2016. Same for expenses. If you incur an expense in 2015, you record it in 2015, not when you pay it in 2016. So that's saying right there. Again, for the overall equity account, you're going to credit to increase it. Again, here, revenues increase owner's equity. Notice the revenue account down here. You're going to credit to increase revenues, debit to decrease. Expenses decrease equities, so you debit for an increase in expense, you credit to decrease in expense. And then, of course, as I mentioned before, dividends decrease owner's equity, so you're going to debit dividends for an increase to it. And I'm not sure when you would decrease dividends. Once they've gone out, they've gone out. And then capital stock, usually what that is going to be an increase, because capital stock increases owner's equity. All right, so it says let's analyze the revenue expense transactions for overnight auto service for the month of February. We'll do this real quick, I promise. February 1, we pay Daily Tribune $360 cash. You know, this should be pretty easy after a while. So we debit this expense called advertising expense. We create the account and debit in our general journal $360 advertising expense. It goes directly into the advertising expense ledger account. We credit cash, reducing cash by $360. And that goes in not only in the general journal, but also the cash ledger account. We purchased radio advertising for $470 on the 2nd, payable within 30 days. So we incur it on February 2nd, even though we're not paying it till later. So we list it as an advertising expense, and then we put it in our accounts payable account because we're going to pay it at a later date. Purchase various supplies for $1,400 payable within 30 days. So we establish a supply account, debit that account for $1,400, and again we credit increase accounts payable, which is of course a liability account. Notice it says in supplies that we expect to use them over the next 3 or 4 months. At this point, that's not really an issue, but it might be later. February 15, overnight collected $4,980 cash for repairs made to vehicles. So we debit cash, increasing it, and we credit repair service revenue, increasing that by $4,980. We bill Harbor Cab Company for maintenance and repairs provided in February, with payment to be received March 10. So we provided the service in February, even though we're not getting paid until March. So we're going to recognize the revenue in February. It's on account to be paid in March. So we increase by debiting our accounts receivable. And of course, since we've earned the revenue, we increase our revenue account by $5,400. And then overnight pays on February 28th. It's employees' wages earned in February, $4,900. So we have a wage expense on 2/28 of $4,900. That increases that expense account. And of course, our credit reduces our cash asset account by $4,900. And then we record a $1,600 utility bill for February. And even though we're not going to pay it until March, we incurred the expense in February. So we record utilities expense for February of $1,600. And of course, since it's not being paid till March, we credit accounts payable for $1,600. We declare and pay a dividend of 40 cents per share on its 8,000 shares, so that's $3,200. So we create a dividends account, we debit it to increase the dividends account. That reduces the amount of our cash by $3,200, so we credit cash $3,200. Now notice, we're just showing the effects of these transactions on the ledger accounts, which is the representation of these T accounts. What we are not seeing is the fact that for each one of these transactions, before we post to the ledger accounts, we have to, for almost all accounts, if they're routine, which all of these are, we have to record them, we have to journalize them in the general journal first. That's the one place that we go to should we need, that's the starting point for looking at most of our transactions during the year, is the general journal. So analyze, journalize, and then we post. So just realize that you're not seeing the full accounting process here. After you analyze, journalize, post, you're going to prepare, usually each month as well as the end of the year, what's called a trial balance. All a trial balance does is indicate whether or not debit accounts equal your credit accounts. If not, you have a big problem, or possibly a big problem. Debits have to equal credits, right? Now what does, in this case, debits do equal credits. What does the general ledger not indicate? Well, it doesn't indicate that you've recorded all the transactions properly, because you might place them in the wrong accounts. You might have transcribed the numbers, 9780 as 9870 for both the debit and credit. I mean, if you do that, debits and credits are still going to be the same, but doesn't mean it's correct. So just remember, and we'll move on to chapter 4, continuing this discussion, that their time focusing on more of the analytical aspects of their discipline, whereas some of this stuff really is more of a bookkeeping type of task.